Okay, good afternoon, guys. Welcome to another live trading clinic. Today, again, we're going to focus on the Bank of England rates. Not really kind of expecting a great deal from the actual figure. Again, we're pretty much all set for an unchanged today. But as I keep saying throughout these webinars and seminars that I hold, that it's not just about the actual figure itself. That's not really what we're trying to get from this right now. We know that interest rates are going to go up at some point because they have to. We're moving in cycles. But it's all about the kind of the language that comes out, any comments that are made, and expectations. I mean, we've seen the FTSE gaining a bit of strength today. We've seen, obviously, the dollar rally over the last kind of few weeks. So everybody's making an opinion about something. So my rule of trading is that markets move 80% of the time, technically, and 20% of the time fundamentally due to new news. Now, today we might not get exact new news, as in interest rates, have gone up. But we will get new news, forward guidance, comments, things that are said, things that are put over the wires, people making different predictions of what he said or what he's not said. So it doesn't matter if we do or don't get anything changed in the actual underlying figure today. It's all the speculation around it that will fuel that 20%. And remember, that 20% will just speed up the 80% technical and kind of analysis framework. Markets will always move between support and resistance. So again, I'll go into this a little bit more about my ideas and my thoughts and about why I choose to kind of commentate over Bank of England and that kind of stuff. After I've just gone through the short kind of risk warning, etc. But what I'll try and make you think about is that we all know the rules of the game. Okay, so it doesn't matter if you're a professional trader, a retail trader, you work for a hedge fund, a bank, you're an economist, you're the man on the street. We all know that things move in cycles. So interest rates have been kept artificially low for a significant amount of time. So it doesn't matter what the government says, what Mark Carney says, at some point they'll have to go up. So it's managing that expectation. Yeah, that's what we've got to think about. How will we manage it, and when will we have to come to the conclusion that no matter what we do or what we say, interest rates will go up because it's an inevitable part of the cycle of the wider economy. So before I start, as always, the risk warning. Remember that spread betting and CFD trading carry a high level of risk or capital that result in losses that exceed your initial deposit. They might be suitable for everyone, so please ensure you fully understand the risks involved. Now, the information and comments provided here under no circumstances are considered or solicitation to invest. Nothing here should be construed investment advice. The information advice we believe to be accurate the date it is produced. Again, education only. Content of the webinar is posted whenever the moderator, not The content is not constitute financial investment or tax advice. Insurance.com does not accept any liability of the content of the during the session. So what we'll go over, as always, is some live charting analysis. I'll go through the charts, and again, we're trying to marry out and figure out, what that interaction between that fundamental and technical data is. Now, as I say, 80% of the time, markets move in a technical manner. Yeah, 80% of the time. So that's what we have to focus on, and that comes down to multiple time frame trading, understanding what the trend is. How do you identify a trend? We don't identify a trend by a minute chart. Okay, you have to go through the time frames to understand what the majority of market participants are trying to achieve. It's a longer term trend that dictates your smaller intraday trades. Now, having written, my book and written other things and taught thousands of traders, you have to believe me that this is the only way to do it. Okay, I know what you're gonna say. Well, Steve, I've read this, I've read that. Doesn't matter. Okay, I'm not saying there aren't a million different ways to interact with your indicators, your oscillators, your technicals, your fundamentals. But the backbone of all trading is that we have to look at what happened in the past to predict the future. That cannot change, ever. Yeah, doesn't matter what you read, what you do, who you listen to. You have to look at what happened in the past. So, a minute chart makes up a 15-minute chart. A 15-minute chart makes up hourlies. Hourlies make up days. Days make up weeks. Weeks make up months. So a monthly close, high and low, has to have more significance than an hourly high or low or close. It has to. It just contains more data. So that's what I mean by multiple time frame trading. They're all time frame trading. What time frames do I use to trade? All of them, because they all have some relevance. What happened in the past, we can use that to predict in the future. So we start off the highest time frame, zoom in to the lowest time frame. Makes perfect sense. There is no other way of really interpreting charts. There is no other way. Because you have to understand what happened in the past to predict the future, but have to keep it relevant to what you're trying to achieve now. So there's no point looking at a yearly chart, and trying to find a yearly high or low in the FTSE from 15 years ago. It has no relevance in today's trading. There was no QE, the world was a different place 15 years, yada, yada, yada. Doesn't matter. Okay, it doesn't have the relevance. If you look 6 months, 6 monthly candles back in the charts, that has relevance to today's trading. Yeah, that's what I mean by multiple time frame trading and using all the time frames to your benefit. Fundamental analysis, well, a key example is this announcement today. It's new news. Even if it's no news, it is news. Now, the big one is going to be obviously tomorrow, non-farm payroll. Very, very difficult to predict the non-farm payroll, and it's the biggest figure. It's the biggest news source of news and information released into the markets. So, therefore, we get great volatility. Right, and then if we see anything good today, which I doubt we will, we're going to do some real money trades. Now, everything I say today and everything I do will stand you in good stead for the non-farm payroll tomorrow. The non-farm payroll, I've traded 42 consecutive non-farm payrolls, only ever lost twice. Now, why is that? Because I'm prepared. I understand. Okay, I've got a set plan for trading it. Yeah, that set plan can be applied to any data, anything that's new. Now, as I said, you only get that 20% of the fundamental news released in your kind of trading week, month, but it gives you a structure, a framework. You know, if you look at FX Street's economic calendar, which I've referenced in some of my ebooks and, you know, I use, you know, because it's a very good, solid economic calendar and it's very easy to understand, is that you look down the list of exclamation marks and you just pick out the things that are, you know, 3 red. So you can look every single day, week or month, there'll be between 5 and 10 events that are heavily, you know, red exclamation marks to mean they have significance in the market, and you just trade them. So if you think there's only probably 20 trading days in the average month, but there's 10 news events, and they're, again, you know, a morning or an afternoon, then really a quarter of your trading time can be attributed to fundamental information. Now, if you already understand the 80% of technicals you're working from, then anything that moves the markets a little bit quicker are just a bonus. So that's why fundamental information is so important, not just because it drives sentiment. And again, you know, sentiment and opinion are driven by people. People trade markets. It's all part of the same thing. So once you understand the, you know, the fundamentals, and then you can apply that to any kind of technical framework that you trust and rely, then trading becomes a lot easier, a lot more manageable. And that's all we're trying to do. So, I mean, I'll use a perfect example if I was looking at the FTSE. Okay, now my long-term view of the FTSE is that we're going to correct, but not till next year. So I still think we're going to get to 7,000 in the FTSE. Now, if you believe me or not, I don't care. I'm not interested. I'm not here to prove how clever I am or how much more I know than other people, right? I've been quoting the Financial Times, Bloomberg, Reuters for many years now, and generally I get things fairly spot on. And it's not because I'm trying to be some sort of guru. I'm just going with what happened in the past to predict the future. Okay, so you know what happened in the past? The S&P hit 2,000, came back down, went above it, stayed above it. You know, Nasdaq went to make new highs, Dow new highs, DAX broke, you know, them up at 10,000 levels, and then remained high. You know, didn't correct. The FTSE is the only one that hasn't hit them kind of psychological technical levels at 7,000. And why not? I mean, the UK seems to be in better shape than the Eurozone. You know, so why would the DAX hit them highs? You know, I'm not saying it's in better shape than the US, but it's certainly more controllable than the US. So I'm just going with logic. You know, we hit the lows in the FTSE down here, and everyone's like, oh my God, FTSE's crashing. Oh, we're all at the end of the world. It's like, no, it's not. We just bounce off the lows and go back up. I mean, I've written again, you know, quite a lot over the last few months about the FTSE, and if you look at the monthly chart, yeah, we see 2 down months. Yeah, 2 down months do not break a 4-year bull run. Yeah, we're still massively high in the charts. And look at this. Bang, all the way down. What's that telling you? A massive rejection. Okay, there's so much money in the indices right now because people don't know where to put the money. The balanced portfolio I got taught, you know, in a different generation, you know, of balancing out your currencies, your commodities, your indices, your FX, your bonds, doesn't exist anymore. Nobody knows what's safe. Yeah, people are buying Google shares rather than Greek debt because they don't know what's safe. All they know is Google's got a shed load of money and it pays good dividends. So indices are being flooded. So this is just all your rich, you know, institutional grade traders taking profit at the top. That isn't panic. That isn't fear. Okay? Look at your weekly charts. Same scenario. Oh, 3 weeks of selling. The world ended. Oh no, the FTSE's going to crash. Bang. No, it's not. I'll take my profit and take it back up and go make new highs. Thank you very much. You look at the dailies. What have I said? Every session, pretty much, I've taken an FX Street buy dips, daily dips. Anything that doesn't close towards the bottom and shows indecision, the next day's green, indecision, green, indecision, green, indecision, green. I mean, it's not hard, is it? You know, you could have made 2,000 ticks just on that in the last few weeks. Okay, and I've been saying this, and again, quoted in Bloomberg many times, saying this in the FTSE. When you see a candle body in the daily that doesn't close towards the bottom and retraces 23%, spot 6 or more, the next day is generally green. Okay, and you can just go through the charts and pick it off. I'm not going to go through every example. There's just too many. But it's just dip buying. We haven't finished that bull run in the FTSE. We haven't finished the bull run in the stocks. Okay? Nobody, when I say nobody, I'm talking about rich people. Remember, 1% of the population controls 50% of the wealth. Yeah? I invest for a lot of rich people. I know billionaires. I know how they work. Yeah? They see a big load of profit. They take it and they put it into something else. But they've got property. They've got houses in London, Monaco. They've got huge, portfolios of cars. The one guy I know, he's got 300 cars. He buys them like the toy cars. Yeah, but he doesn't know what else to do with his money. So when he gets, these investment advisors tell him to pump it into stocks, and they do. When we get to the top, they just take it out, and then they buy it lower down because, again, where else are you going to put your money? So when we look at the hourly charts, what we're trying to do is say, okay, well, just trying to pick them dips. So, look at your Bollinger Bands. Low point in the charts, down move, indecision, close inside the Bollinger Bands, moving average, go on to make higher. So the whole point of the higher time frame trading method is going to the monthly like it did, rejection. So we must be going back up to the weekly. Well, we still massively rejected the lows, going back up. Where are the highs? Well, where they were before, up just before 7,000. So we go to, our daily chart, try and pick them bottoms and them key levels. Then again, just use our hourly charts to do the same. Use Bollinger Bands, use these key Fibonacci levels. So if we get above the 50% on the hourlies at 6533 spot 30, then again, these upper levels are the targets. And again, people thought I was saying that to get back to 7,000 down here. They were like, oh my God, Steve, you're crazy. How can you say that? That's like, 1,000 ticks away. Well, it's not 1,000 ticks away anymore, is it? It's only 500 ticks away. Yeah, a lot can happen in a day. A lot can happen in a week, in a month. Yeah. 1 down month, 2 down month do not break yearly trends. That's higher time frame trading in action. What happened in the past will happen in the future. Every time we're low in the FTSE, in the charts, over recent months and years, we buy back up. Okay? You're starting to see this picture. And you can do that with any product. Yeah? It isn't rocket science. You can do it with any product at all. Do it with the euro dollar. Yeah? Do the same thing. If you want to, go on your monthlies. Bring them up. Are we going to go down? I'll show you in a blank chart. Are we going to go down? Yes, we're going to go down. Why? Because the Eurozone's finished. Mario Draghi is an idiot. He doesn't know what he's doing. Okay, so higher, low, higher, low, higher, low, higher, low. Okay, so we've gone from the highs to the lows here. Where's the 50% that we know is our pivot? Here. So how's that acting as support and resistance? Hands up. Is that support or resistance? Anybody? That's right. Well done, class. Resistance. Double top market's coming down. So where's it going to go? Well, you don't have to be, a rocket scientist or, a great technical analyst to see that 1.23027 is some lows. You break that. Okay, you've got your low points here of where we took this Fibonacci from, and then below that, anything you want. Just getting back into the range here. Do it another way, and here's another trick. Do your Fibonacci from the low to the high, but the opposite way around. Then you get your expansion points. Okay, so here, it's the high to the low. We're making the new lows. If we do break through here, yeah, I'm not saying that it's going to take, no matter of time to get to these lower levels, but your natural correction point, when we've broken these lows in the monthlies, is below 1, so 0.9316. Yeah, so another way of doing it. You don't have to do it that way, but if you look at, the monthly onto the weekly, again, it's showing you every time we hit the highs, the market's happier to sell off. So take a fib, do some, Bollinger Bands, whatever it takes, do whatever you need to make that chart make some sense to you. But the daily, as always, is going to have significance because it was the best way to show you the trend. Just because you can fit a good amount of data on and just say, right, well, every time we get to the high points in the euro dollar, yeah, it looks really strong. But then we don't close strong and we go down. It's the opposite of the FTSE. Yeah. So then you look on your hourly charts to find the highs. Bollinger Bands coming together here. A couple of rejections, another fib level here. So we close below one spot 258083. Then the market's going to go down. And then again, all you do in 15 minutes trying to find that right entry. Okay, trying to pick the upper point of resistance. Yeah, to find the market get a bit of weakness and then come back down. Okay, so that's that kind of technical mythology you're trying to put through into your charts. You're trying to push through what happened in the past to predict the future by looking at what you know. Okay, a monthly high and low, open and close can't be changed. It's set in stone. Okay, an hourly open candle can be manipulated. Yeah, any way you want. It could be 100 ticks up to 100 ticks down. yeah, in that last final minute before it closes as an hourly candle. Yeah? Yeah, any smaller time frame candle can be open to manipulation. But a monthly high, low, open, close is set in stone. Okay, so you build your picture and framework around the month, week, and days, and then bring that, drag them levels that you see here into your kind of intraday chart as a framework. Okay, and there's any products anyone wants to look at in particular that we can go through this and let you understand. I've done the euro dollar and I've done the FTSE. I mean, gold's another one. But just today, the FT were putting a point up about, gold bears are back in charge. September of 2013, I was quoted in the Financial Times saying gold will hit $1,000 by 2015. Don't know if it will, but it won't be too far off. It's going to be closer to that than it is 1900. Yeah. When I was saying this, monkeys and muppets out there were saying that gold could get to $5,000. Okay, it's all about having an idea in your mind and then letting the market prove it with the fundamentals and the technicals and getting involved. I'm not always right, okay, but it doesn't matter. I'm only ever aiming for a 70%, kind of idea of being right and then just managing your risk intraday. I don't hold yearly positions. I don't hold monthly positions anymore. I don't need to. I just get involved from my view. So every time gold's high, yeah, on the daily chart or the hourly chart, I sell it because I think longer term is going to go down. That's just having, an idea of a plan. So when the FTSE's low, I've got an opinion it's going to get 7,000. So at the low point, I find value. So I can move and trade around that as the markets move. And again, trading's not about being right. It's about being right at the right time. I can say the FTSE's going to go 7,000 and lose money buying it all the way up. Yeah, it's not about being right. It's about being right when the market gives you them opportunities. So there's no products anyone wants to go through, guys. Nobody wants to go through any commodities, any currency pairs. I can't believe nobody wants to go through anything. We've got 13 minutes while this Bank of England, announcement comes out. I mean, going back to that, what baffles me is that we don't get any clear forward guidance. Mark Carney said back in June that the rates may move quicker than the market expects. So, why is he saying things like that? Why is he trying to outguess or taunt the market? The market will destroy you if you try and play with it. The market is the most efficient way of getting involved in fear and, exploiting weakness. So Mark Carney really, is saying that interest rates are going to go up. And I've said for a long time on FX Street that interest rates will go up in the UK quicker than any other, G8 nation. And I'm right. I'm going to be right. Is it going to be early Q1 2015? I just don't know. It depends on the, the non-farm payroll, I guess, tomorrow. And it depends on how frightened they are about household debt. I mean, household debt's not going away, but it doesn't matter. You get a mortgage for 25 years. So anyone's got a mortgage over the last 5-10 years still has 10-15 years to go. So interest rates will go up at that point in 10 years. They have to. So the pain's going to come to people at some point. Okay, so it's when it comes, and that's what the market now is trying to predict. Will it be Q1? A lot of people are saying now Q2 because the US have come out and we've kind of priced in September rate hikes. But everyone's pricing in rate hikes because they are inevitable. So today we might get unchanged, but that unchanged will ripple through to the next quarter, to the next, couple of months worth of trading because it gives us another solid piece of information. Unchanged now, but likely to change up soon. Okay? Oil. Someone's asking to look at oil. Oil's back in the news. Again, inelastic demand. So it doesn't matter how low oil goes, there's still going to be demand for it. And yeah, it's had a natural correction and it's come off quicker. But, oil's been going up for pretty much ever. So when it does correct, it corrects hard. So all you have to do, again, look at your monthly chart. Okay? Brutal. Absolutely brutal. Unlike the FTSE that did this, yeah, we got to the lows and then came back up and retraced. So anybody now that's long oil has been destroyed because nobody can, hold on to gaps like this. So your next level of support is down here. So if we break that on the monthly chart, well, there's just nothing. There's absolutely nothing. If I was going to, well, on Brent, there's nothing. There's nothing I can tell you. Yeah, we're at lows. We're at 82.68. I have no idea where gold could go. Oil could go from here. I would say the only way you could do it is do a fib on the gap. I mean, that's too difficult. What would I say? Maybe. Nope. I would say that the best way longer term, because we're on the weeklies now, the dailies. well, I don't know. I would say, unfortunately, until that gap closes, we're still very, very negative. But to say where oil could go because I don't have enough data, probably the only thing I could do is a Fibonacci expansion. And again, even that's difficult because you don't have a great deal to go on. So, sorry, so the Fibonacci extension, it probably won't work here. But I'll try it. Yeah, maybe the lower levels could be 79.39 and 75.96, and that's going off daily kind of movement. No, just too difficult, really. I mean, what we're going to see in oil is, again, when we look at these monthly charts, it's absolutely brutal. They're selling this huge, huge gap. Very, very technical trading here because the gap doesn't close and we're going to make new lows. So I would say realistically, what you're looking for is a good level on the low side. But where that'll be, I don't know. It's like catching pianos here. When you find it, you're going to see that oil probably over the space of a week will just go like this. One solid candle. Yeah, we'll just buy up for 5 days in a row, close this gap, and then get some parity. Very, very difficult, that, to be honest. So oil, I would say generally that's just too difficult. It's just too difficult to trade. So I'd say unless you can think of a really good level below 80, I'd say anywhere around here, and then just pick, a very small position and hold it. When we do see the natural bounce, which you have to in oil, it's inelastic demand. We all need oil every day, so it will go back up in price for sure. But when you kind of spotted a trend, it's too late. So I'm not looking to sell it now. So there's no value selling it down to 75. I'd rather buy to 75 to 70 and then, sell it back at 90. So again, that kind of risk reward. So what about the pound versus the dollar? So a bit of cable. Well, I mean, we've seen a lot of dollar strength. So we're seeing the pound, kind of sell off. But I still think, again, going back to the monthly charts, that again, we've seen, a natural kind of Fibonacci. So I am still bullish, the pound, because obviously interest rates are going to go up before they do in the US. So people are going to buy the pound. You're going to get more value for your money versus the dollar. But in the meantime, what we're seeing really is the kind of that theory coming into play, but more the institutional taking advantage of it. I mean, we've hit the lows here. We've still continued to move higher. In the pound versus the dollar. So, higher, low, higher, low, higher, low. And we're really kind of selling off now in the monthlies because we know interest rates are going to go up in the UK before the US. So really, what this is institutional kind of traders getting out of their positions and central banks getting out because they were buying down here, and down here. So they're getting out, and all the retail traders that understand that interest rates are going to go up are buying it and getting squeezed out. So what we're going to see is probably the market bottom out around these low levels at maybe like 1.534, and then go on to make new highs. Until we break this low, yeah, we're still going to make new highs because this Fibonacci, again, we're below the 50%, yeah, but we haven't really made that new low yet. So really, it's a difficult one because we've got on the upside, say 2,400 ticks for argument's sake, and 2,500 ticks on the downside. So unfortunately, we're kind of at the 50-50 point now. So we're closed below the 50%, so we naturally could go lower, but I don't think we're going to test them lows. I don't think the UK is going to be weak enough or the demand's going to be weak enough to break these lows. So if it can't make the lows, then according to Fibonacci, it has to hit the 50% and then make new highs. So we're still holding above that 23.6. Okay, we've closed below the 38.2, but until we close the 23.6, we're still more likely to be buying these lows to get to the 50% to make new highs than we are to sell the 50%, hold below the fibs to make new lows. Okay, so I think the fundamental outlook and the strength of the UK economy, the strength of the UK in general, mean there's going to be demand for the pound. So I would be buying lows. Yeah, so just take that Fibonacci through to your weeklies, yeah, and your trend line, and you can see, how the market's reacting. But what you want to do is see the market come down to these lower levels, hold, and then start to hold above the 38 or in the 50. So longer term, I still think we're going to get above 1.73, and I wouldn't be surprised by kind of mid-July, August time, before we kind of like made a solid rate decision from the US, that we get closer to 2 for the pound against the dollar. That's what I think. What do you think about the euro dollar today? I think the euro dollar again is going to depend on what the ECB say. The ECB are panicking. Mario Draghi, while the rest of the world talks about putting interest rates up and ending quantitative easing, Mario Draghi's talking about putting more quantitative easing in and keeping interest rates low. Well, interest rates keeping low hasn't helped the EU so far. And quantitative easing, where's the money coming from? They don't have the money of the UK or the US comparatively, because it's all coming from Germany. So how much quantitative easing can they bring, and what good will that do? So the euro, for me, the euro dollar is negative. It's going down. I reckon within the next 5 years, as I've said many a times, the euro dollar will split in two. The euro will split in two. It's just, I've lived in Spain for many, many years, and I've just seen the change. I've seen the change in people's opinions. So, we do see a little bit of relief rallies at the low in the euro. But again, look at the dailies. You're just looking to sell. So you look at the high points on the hourlies. So again, look for these pivot points and sell it back down. So again, I just think it's going to go down. I would say once we break the monthly levels again back at 1.23,290, then the market's going to got great levels to hit. So I wouldn't be surprised by the end of the year if we're not trading closer to 119, maybe 118. And again, the faster something falls, the more aggressive it is. Look at WTI. The faster things fall, the more kind of momentum comes in. So really, we've traded in this nice range between the lows and highs, since July. But really now we've traded below major support here. So once we break these kind of lows here, which we're not too far away, down at as I said, 232.90, then these lower levels are going to happen. So I would say negative the euro. I've always been negative the euro. I've always sold highs in the euro against any other currency. Always. I've always sold highs in gold, bought lows in FTSE. These things I've told you time and time again, month to month to month, weeks and weeks. 4 years I've been in FX Street. And I can say hand on heart for at least the last year I've been saying, I was massively bearish the euro. Okay? Yeah. Bearish the euro, bearish gold. They're the two ones I've stuck by, absolutely rigidly. So I don't see any good news coming out of the Eurozone. So it is going to continue to weak. So look for weakness. That's all I can say. All right, guys. Anything else? If you move the fib, what's Ian saying? If you move the fib to the start, right, you get some great hits on levels. Yeah, that's the whole thing, Ian. The whole point is fibs are quite difficult, and people don't like to use them because they don't have a set way of using it. I use my fibs in my way because they give me the confidence to stay in trades and get in trades. But you're absolutely right, Ian. If you use the fibs, they do start to become self-fulfilling. So if you pick a good one, keep it on your charts because they do come back out. Or you're talking about cable. Yeah, it doesn't matter, does it? What the product is. A fib's a fib. So if you pick a good high and a good low, fibs will come into play. That's how Fibonacci works. So cable, WTI, euro dollar, it doesn't make any difference. It's all about, picking the right points and then having faith in them fibs. So Bank of England now in a couple of minutes. So we'll look at cable over the Bank of England. So we're looking for any kind of, good positive news to send the pound back up. So we kind of rejected the lows down here. So key points to get back would really be, these upper levels here, maybe get to 160.520. Again, seeing a little bit of strength come back into the bottoms. So just a couple of seconds, 30, 40 seconds or so now. So we're expecting unchanged, but let's see if there's any movement after it. Just because it's a non-event for the headline doesn't mean we won't see movement. So unchanged, as expected. So it's all about inflation now, isn't it? Well, look at the inflation expectations coming out next week. But what really kind of amazes me is that when we talk about cycles in the economy, we talk about growth through inflation. We've ignored inflation for 6 years. Okay, so why has it now got some relevance? Well, because we're talking about interest rates. But interest rates are controlling inflation, but they've been kept historically low, and we've sacrificed inflation because of that demand for growth coming from the low interest rates, keeping people spending, borrowing, and buying. So I don't really see how inflation can now dictate interest rates. Interest rates, we're taking a punt. We don't know what effect it'll have on the economy. We know it'll be bad, but we don't know to what scale. So the whole point is that looking at inflation data now is absolutely relevant because inflation has been created and born out of false false parameters. We've kept interest rates historically low artificially. So it didn't matter what happened to inflation. We couldn't really do anything with inflation because the only way you control inflation is via interest rates. So we've kept them low. So inflation's just done whatever it needed to do, whatever it had to do. So inflation now, is it in control? Is it not in control? I don't know, but we can't just suddenly switch from growth cycle to inflation cycle and start to build our decisions on interest rates on inflation data. So it doesn't matter when the inflation data comes out. We're still on the repercussions and them kind of follow-throughs from what's happened with the false growth that we've tried to kind of manufacture and manipulate by keeping them rates low. So it's going to be interesting to see what Mark Carney does, because it doesn't really matter what he says. We can put a nice spin on it, but interest rates have to go up because that's the nature of the beast. That's the nature of the economy. In America alone, we've lost $1.3 trillion by Americans not having any, money back from savings. So if there's no money to be had in the banks, then where'd you put it? Back in the indices. But you have the indices, spiking and rallying, because there's no kind of where else to put your money, then that's bad. And then, all these, companies like Google, Apple, sat on, billions and billions and billions of dollars, not paying tax. All these things have to be addressed. They can't continue forever. So, again, going back to people with, thinking they're well off because their house keeps going up 10% a year. A house is only worth what someone will pay for it. And you have to live somewhere. So if you sell it, you realise that money, but you have to go and buy somewhere else. So we're kind of in this interesting situation now where everything seems to be fairly steady and growing and fixed until we move interest rates. And that's the complete unknown. So we're looking for them figures out of the inflation data to build some framework around, but they're absolutely irrelevant because they're being all created under false pretenses. So really, nothing was said there. All we're doing really is kind of trying to focus and push the attention to the ECB now, because Mario Draghi is more likely to say something that will affect the markets than the Bank of England. The Bank of England are just playing that wait and see game. No proper forward guidance, no really kind of any kind of clear message. Just kind of we'll do things when we have to, and it might be sooner than you think, or it might not. It's all pretty pathetic, to be honest. So the ECB is something better to focus on right now. And again, anything positive out of the ECB, that's fine. What I do is anything positive at the ECB, like we're going to bring in more quantitative easing, then just let the euro spike and sell the highs, because we know longer term it's not really going to fix anything. They didn't fix anything in the world, or it's yet to be proven. So if the UK and US have finished with quantitative easing, well, the US have finished with quantitative easing, but if everyone else is winding down that stimulus and looking to normalise the economy by putting rates up, and the eurozone, the second biggest economy in the world, is doing the opposite, then what does that say to the world? Yeah, it screams of desperation. It screams that they haven't got things right, and they're still guessing. They're still doing things that didn't work or haven't proved to be worked, and have no real answers. So really, yes, a bit of a non-event there. There was no change in the interest rates from the Bank of England, but again, we saw a bit of movement. We saw the market kind of try to get up, and it's come back down to a ranging. So yeah, I mean, what I would say is that while we don't say anything from the Bank of England, and while we don't change, the likelihood is that everyone's pricing in that interest rates will go up, and we know. So it's just how quick. So if you think it's going to be first quarter, you need to be buying the lows if you're a long-term trader now, because you won't see these lows in the pound for much longer. Because the closer we get to interest rates being inevitable, and they are going to happen next year, no matter what, they are going to happen next year. But you need to pick a point, and again, pick a point from the weeklies or the monthlies where you think them lows. This might be a double bottom. So in 3, 4, 5 weeks' time, yeah, we're trading up here. But if you want these prices, these low points down here, you have to get them now. Okay, or you might think, well, we're going to go a little bit further down to here, and then we're going to get back up here. But what we are going to do is go up as interest rates go, because people will swap their currencies to get the interest rate from the pound, because that's going to go up before pretty much any other G8 country. So it's simple supply and demand. People will demand the pound because you get more pound for your money. But it depends when you want it. You want it down here, here, or here. So you start buying low now, or anticipate the market's going to lower and then get to here, or you buy it on the way up. But again, you have to have a plan for what you're trying to achieve. All right, guys. Well, as I said, I mean, the Bank of England I've chose to do because eventually I want to be here. After saying that the interest rate's going to go up in the UK first, I want to be here when it does happen. Because, I've been saying it for a long time now. And I've not been saying anything that other market commentators, I guess, haven't anticipated. I've just been saying it longer. And, I stick by what I say. And I come into FX Street every week, 4 times a month pretty much, and tell you, the same kind of things. So I've not changed on my opinions, and I haven't changed on what I think is going to happen. So what we're trying to do now is build a framework on the higher time frame method that I've told you to get involved and try and make some money. Because that's really why we trade FX or trade anything, is to make money. We're not doing it, just out of pure enjoyment. No, I didn't trade the Bank of England announcement. I was out, actually. But there we go. That's just one of them 20% fundamental things that you're either here or you're not. So, yeah. Again, good for the markets in general. It keeps on, in my opinion, the FTSE's going to get to 7,000. And the trouble is, with China and Japan, we don't really have any control over what they do. So the fact of the matter is, if they're bringing in, this new stimulus and changing their plan, that's worrying because, China's got a 100-year plan. Japan has a, very long-term strategy. And I don't ever think quantitative easing was one of them points. So the fact they've come in, it'll be a short-term bit of relief for the markets, but long-term is bad. If another major player in the global economy is finding it, hard to keep under its own steam, then long-term that has to be bad, doesn't it? It can't be a good thing. All right, guys, that's pretty much my time. Thanks for all attending. I've got a free ebook knocking around, so if you want to get a free ebook on my 80-20 rule, just go to the link here on the homepage, and you can get that. Apart from that, guys, again, look for this bit of a sell-off now in the pound. So look for the low point. I would say definitely 1.58897 would be a buy point. So we break these lower Bollinger Bands. Got massive resistance down here. So I'd definitely say if you do say a quick sharp sell-off of maybe 70 ticks or so, buy some lows down here on the hourlies because they're going to bounce back. Because again, the overall view is that really we're going to get high. So again, look at the daily bulls, the rejection, and then look at these low points in the hourly and buy it back up. All right, guys, been an absolute pleasure. Anything else, please, do get me on Twitter at Steve Ruffley. Thanks to FX Street and the guys, and I'll speak to you all very soon. Okay, guys, have a good afternoon.